is 8 o'clock on the nose, so we'll get started. And I was telling a few people when I first arrived today that that I was working ahead and eager, and the data that we share is updated every day, and we have to get it approved. And so I was working ahead last Monday and thought I'll download everything so you can see that it's effective Friday, July 26th. And, and kind of a lot has happened since then. Now, I'll say a few things to say our focus in this presentation is on the big picture, and very few things have happened from a big picture standpoint. But it's kind of jarring. And so I want to start off by talking about two things that happened in the last week that I think have had an outsized impact in the short term on stocks and probably are generally irrelevant to us long-term investors. So the first thing is the unwinding of a little thing called the carry trade. And the carry trade is this idea, and you'll see this in a little bit. We have a slide here, but central banks around the world have been raising rates for the last several years, most notably the Federal Reserve here in the United States, to combat inflation. The lone exception to that was our dear friends in Japan have kept interest rates at zero, where they've been for a very long time in Japan. And so what became very popular over the last several years was borrowing money in Japan in yen at next to nothing or 0% rates, like we all experienced, in the decade primarily leading up to that, and then converting it into dollars and investing it somewhere else. And the minute last Wednesday, so a week ago today, the central bank in Japan finally, after many years, raised rates. And that created a cataclysm of events that meant the people that were doing the quote unquote carry trade, where they were borrowing in one currency and investing in another, saw their portfolios all of a sudden out of whack. That really impacted the relationship between the dollar and the yen, and it screwed a lot of those trades up, and people were forced to sell to right size their positions. So, when you're borrowing to invest, you have to have a certain amount of margin, and you have to have a certain amount of skin in the game. And the answer is, if you're out of whack, you got to sell stocks. So that really took off last week, and really over the weekend. We saw Japan stock market Monday morning panic selling, 12% drop. The last time stocks had dropped that bad in Japan had been Black Friday, 1987. I was a small child then. And so, it was a very unusual event there. And then the European markets opened. They sold off, somewhat panicked, not as bad as Japan. The US markets opened, sold off 1,000. We saw the Dow go down 1,000 points. But again, not nearly as bad as what was happening in Europe or Japan. And then, of course, yesterday came roaring back, not all of it. Today, the futures market would indicate will be another strong day for stocks. So all this is to say, a lot of short-term volatility. So that carry trade was one thing. The other thing that happened was Friday, the Labor Department, as they do the first Friday of every month, announced the jobs report and the labor report and the unemployment rate for July. So the first Friday of every month, the Labor Department shows up and says, here's what happened last month in the employment market. Two things happened. One is we created a lot less jobs in July than we expected. We created about 114,000. The market was expecting somewhere close to 180,000. Okay, fine, whatever. We still had more jobs created than lost. But the unemployment rate went from 4% to 4.3%. So, you're going to see a little bit of the old data today. So the unemployment rate ticked up a lot. And what happens is a thing called the SOM rule or hypothesis is that every time the unemployment rate has jumped by 0.3% over its 90-day average, which happened on Friday, we are in a recession. Now, the economist is a woman with the last name Sam who came up with this, and she was quick to go on the news on Monday and say, this is not a leading indicator. So everybody woke up Friday and then Monday and said, oh my gosh, we're headed into recession, sell everything. And everybody forgets that we had a much better GDP report 2 weeks ago than expected, that the economy in the second quarter actually expanded more than economists expected that it would. It's hard to say you're in a recession when your economy is growing and growing faster than you expected. But, you know, markets tend to feed on fear. And so, you know, one of the things that was pointed out to us by some of the third-party researchers we use is that when you have days like Friday and Monday, you have the bears. Bears are people who think the market's going to go down. They'll sell at any price, right? Because they think stocks will inherently be lower in the future. So they'll sell today. Your bulls, the people who are buying, don't buy. They wait for the blood in the streets and then they buy. And you're starting seeing that yesterday and today. So, you know, we're on this long-term ride, but it's a very bumpy one, and it's driven by external factors we don't get to control. That's the nature of stocks. Stocks are still positive over this year. They're still positive over the last 12 months. But as we all know, it's several steps forward and then several steps back. I will say this, and we'll take a look at this as we go through today, but I think for long-term investors, we don't want stocks to get too overpriced. It's always violent when it happens. And we've experienced a relatively boring year. I mean, stocks just have done well November, December, and every month this year till now. We saw the market positive, except I think in April. So stocks have just been kind of not making a lot of news. And then all of a sudden, boom, here we are. So I'm going to now get to the presentation I had planned, but I wanted to kind of give you that preface as to, you know, some of it has changed since we were there, since we last talked. I was planning, and I'm still doing, to start our presentation, talk about the upcoming presidential election. We get a lot of questions about this. And I would say there's a lot here, but what this chart tells us is a couple things. It's our own personal biases seem to indicate what we think of the economy. And so when we have a Republican president, the red line think that Republican people who identify as Republican think the economy is good. And when we have a Democratic president, those people would say the opposite. And then the people who identify as maybe Democrat are the exact inverse. Now, what's the truth? Let's look at the bottom. In George W. Bush, stocks were actually negative in his tenure. I don't blame him for it. The real GDP growth was 1.9%. If we look at President Obama, the S&P 500 averaged 16% a year during his administration. GDP growth was 2.2. President Trump, 16% return on stocks, very similar to President Obama's, and the economy grew 1.8%. Under President Biden, now this changed a little bit in the last few days, averaged 12% return annually on stocks since President Biden was elected and, sworn in, and then 2.7% GDP growth. I don't take anything from this chart to say other than presidents don't really have that dramatic of an impact on stocks, and they don't have a huge impact on the economy. They have some influence, but the reality is we're a free market. We're not, this is not China. This is not Russia, where the president gets to put their thumb on the scale in a heavy way. So I'm not going to make any suggestions on how you should vote, but I don't think it really matters. George W. Bush happened to have bad luck because he experienced 2 bear markets during his presidency. President Obama had none. There were no bear markets during the presidents. And during President Trump's presidency, there was really no bear market other than a 30-day stretch in 2020 at the beginning of the pandemic, which market and stocks quickly recovered. So all this is to say, presidents tend to be more victims of good luck or bad luck. And, you know, there was a certain candidate this week blaming the other candidate for the losses and taking credit for the good days. And we all know that's a bunch of malarkey. You don't have a whole lot of things. So I think it's important everybody vote. I think they should vote. And a lot of people do vote with their wallets. But for me to sit here and say that, well, one president's better than the other, I don't think there's really any data or correlation that would indicate that. So let's focus on stocks. If I pulled this chart yesterday, it had moved a little, but this is really going back to 1996. So we're looking nearly at 30 years worth of stocks, but just the last several cycles of the market. And you can just see kind of a perspective of where we are, very close to all-time highs. And so stock market continues to go up and come down. But again, I will say this, I do think stocks are a little expensive. Now, the good news is they're a little less expensive. And what I had planned to say today before, what I had planned to say a week ago at this time was that we see three lines across the screen. And if you've seen this presentation before, this chart is familiar to you. The jagged line, the gray line throughout this is the earnings multiple of the S&P 500. And so long-term, that middle line you see there, dotted green line, the 30-year average is about 16 times earnings. So stocks on average trade at 16 times their earnings. So that if my company made $1 per share, my share price on average should be about $16. We have a 30-year view of this. If you go back to 80 and 100 years, it's also very close to that. The top line and the bottom line are standard deviation. And basically, it's just saying how close are we to our long-term average valuation of stocks? And that the biggest determinant of the value of stocks is how profitable is that company. Not who's the president, not is what the yen is doing, not any of these other data points that have somehow become what's the unemployment rate? It is how is that company profitable? So the biggest determination of value of stocks is how profitable is the company I'm owning. And so we know that they should be, but when we start trading at 20 times earnings, maybe we're getting a little expensive. When we're trading at 12 times earnings, we look awfully cheap from a historic perspective. And there's a number of different measurements and relations of price to earnings. You're seeing this box at the top. We're simply looking at price to earnings in general. There's cyclically, that CAPE is the thing called cyclically adjusted price to earnings. But all this is to say is this line told me a week ago that stocks were a little on the pricey side, that perhaps a correction would be in order before too long. I looked at this chart yesterday and I didn't have time to add it just to contest, but that top line has now moved slightly below that dotted line, that dashed line. It has not moved dramatically, but stocks went from being a little expensive to maybe kind of expensive, but still within a normative range. So from a long-term investor standpoint, I want to see that gray line in between the top and the bottom, because otherwise stocks are either severely depressed, as we saw like in 08, 09, or they're severely overpriced, as we have seen a few times in recent history. So, we were starting to see stocks get expensive again, and they now have kind of moved back into a more normal range where I'm comfortable. But I would have said to you a week ago, we might expect some turbulence ahead just on the basis that stocks look expensive. Now, they're still on that expensive side. And if this market recovers all its losses very quickly over the next few weeks, I would make the same argument of what you're seeing on the screen. So couple things to think about. We talk about the S&P 500 for a long time. It's a very helpful measurement. It's the 500 biggest companies. It's kind of a good gauge, but there's a couple of things that are a little tilted in the S&P 500 that I think are worth paying attention to. This green line on the left side is the top 10 or the 10 biggest stocks, and we'll talk about some of them here in a little bit. And they are trading at 30 times earnings, and usually the top 10 stocks historically have traded at 20 times earnings. So that top tier, and these are companies like, and they're in the small print at the bottom, but I'll tell you, Microsoft, NVIDIA, Apple, Amazon, Meta, Google, Berkshire Hathaway, JP Morgan. These are companies that have gotten a little, they're probably a little overpriced. And we're going to talk about a few of them, but they're also driving a lot of the returns right now. And what we're seeing here is if we look at the remaining stocks, they're trading at 17 times earnings. Their long-term average is around 15. What this tells me is there's a tremendous amount of value in the stock market right now, by and large. There are a handful of companies that are dramatically overpriced that are getting a lot of the attention. We're going to talk about a few of them here in a moment, but that's a little bit of what's going on. And we could also see that those top 10 stocks, if you look at the upper right hand, now make up 35%. They've gotten so big, so fast. Apple, Google, Amazon, Facebook, they've all gotten so big that they're just these 800-pound gorillas sitting around the S&P 500. And so they're driving a lot of the returns of it. But I think there's a lot of value in stocks. It's probably, we want to look to some of the other smaller companies that are getting ignored. So in that same vein, I want to talk about this idea of the Magnificent Seven. These 7 tech companies have gotten a lot of attention. So, and I believe all of them are in the top 10 on the S&P 500. So they're 7 of the 10 biggest companies in the United States. Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. And Google has 2 different companies, Alphabet and Google. And so they're both, I believe they trade differently. But all this is to say is if you look at the share of returns and their share of their returns, you can see that how if we take that, if you look at the blue line and we look at where stocks are without those 7 big companies in there, you'll see that stocks have done well, but there's, I think, a lot of value in the market. And so, you know, our long-term strategy reflects a much more diversified portfolio than concentrating in some of these big hitters that drive a lot, but also add a lot of volatility. If you look at the bottom right-hand corner, what you'll see is how those stocks performed. They lost a lot in 2022. They made a lot in 2023, and they're doing well in 2024. But they're getting a lot of the oxygen and attention. But for long-term investors having broadly diversified portfolios, I would also argue that they're a little overpriced relative to their long-term valuation. So thinking about stocks, and again, I will update this chart for you, but this is a chart that we share often with our clients. And this is the S&P 500 returns for the last 44 years. On average, 33. So 1 or 3 out of 4 years, the markets are positive. So we have a down year, 1 every 4 years, but they tend to cluster, right? And it's not like we make money for 3 years and then lose it in the 4th. And so what we're seeing here is a pretty normal year, even with what's happened in the last few days. So these bars show you how the market has done in the year. The red dot shows the most negative moment during the year. So until last week, the worst part of the market we had seen was the market's stocks in April lost 5% and quickly made them back. And we've been averaging 14. We're on a track to average a 14% rate of return this year. That is now at 9%, not 14. And we've seen a pullback of 8% over the last few weeks in the S&P 500. Now, that's not in everybody's portfolio. That's just looking at those big companies. So this chart still looks very similar, but it's just a little different. And it'll look different again in another week or two. And then bonds do the same thing. They tend to be more stable than stocks. So if we look at the last 48 years, bonds have been positive 43 out of 48. So closer to 85 or 90% of the time, we expect bonds to do well. But they typically will trade in a range during the year. And there's some point where bonds lose money during the year. Bonds, by the way, have done spectacular over the last 4 or 5 sessions. But bonds had started to turn positive here over the summer. We'd seen them down a little bit this year. But I think now that the Fed is hinting pretty heavily that it's going to cut rates, I expect bonds to do well. And we'll talk a little bit about that here. So here is, there's all sorts of measurements on the left, but what I really want you to focus on is the right side of the screen. What this is showing is the blue bars to the right will show the impact on bonds if the Fed would reduce interest rates by 1%. And the left shows if the Fed raises another percent, the impact. So we know that as interest rates go up, bond prices go down and vice versa. So bonds have taken it on the chin or been pretty blasé or flat over the last several years. 2022, we know, was a very challenging year for bonds because the Fed dramatically increased rates. But what this tells us is I don't know where the stock market's going to go this year. It's had a good year so far. It's been very bumpy lately. What I do know is if the Fed cuts rates, that'll be pretty good for bonds, and we would expect bonds to do very well. So bonds are at this place where I think they're kind of close to the bottom of the cycle. They've been there for probably a year or so. And unless you're owning a lot of 30-year treasuries, which I wouldn't recommend, even if the Fed would have to raise rates, if the Fed would have to raise rates, it probably wouldn't beat bonds up too much. But if the Fed starts lowering rates, we would expect bonds to grow pretty aggressively. And so I think bonds will go back to being that good shock absorber in the portfolio that they have historically been, but maybe in the last 2 years have not. So, yeah, 30-year treasury, you could make a lot of money on a 30-year treasury. It's very volatile because you're making a bet on lending the government money for 30 years. And so that just can, that can be a very volatile trade. And so we tend to stay away from that. But now let's switch or move away from stocks and bonds. And I want to talk about the broader economy. And we'll start with looking at GDP. And again, we continue on this upward trajectory. We have averaged 2% growth going back to 2001. And if you looked at, when we looked at the GDP in that first slide of presidential returns, they were all clustered right around 2%. Just not a whole lot of change. The only real significant blip in there was the pandemic. And we're back on track for that long-term 2% growth. We're a little above average right now, but we're just trending in that way. The other thing I like to remind people is and it's at 67% right now, almost 68, but roughly 70% of the US economy, if you look at the right side, is driven by consumption, consumer spending. We are a consumer-driven economy. Yes, we have some industrial stuff. The government spends a lot of money. That's the green bar. But by and large, what the consumer does matters, and it influences our economy more than anything else. And so that is why the Fed pays particular attention to inflation, and they pay very close attention to unemployment. Because when unemployment is low, people have jobs, or they feel comfortable they can always get a job, and they're more free to spend, and that tends to drive the US economy more than anything else. Yeah, Rich.
I was just like, on the government spending, when the government's consuming, which category was that?
So the government spending gets its own category, but they're consuming across the board.
So their consumption is in the government spending.
Yes. Yeah. They drive the economy in their own right. Speaking of which, that brings me to my next slide. And again, things that we think have don't have a really short-term negative impact, but certainly have the longer-term impact that we think about. Because we want to be thinking long-term is federal spending. And neither party in recent history has had any discipline around spending. And you'll see this here. On the left is the spending of our government. On the right is the income minus expenses, right? And that means we had to borrow to get through this fiscal year about $2 trillion with a T, or $1,900 billion. To just break even there. And so right now that doesn't negatively impact us too much because again, the federal government is not paying too much interest. If you look on the left side, interest costs last year were $892 billion. That's them paying interest on the debt, but that could become more painful over time. And so we've been able to borrow money, and you'll see in a little bit, people are still willing to lend it to us for next to nothing. And so we've had this ability to borrow, I won't say at 0% interest, but very low interest. And we'll see that here on the next, or in a future slide. But at some point that will come to an end, and we will either need to raise taxes or cut spending. Now, I'm not the smartest of person, but we know that retirees are the largest voting bloc. And so we like to tell our clients that cutting Social Security or Medicare would probably be the most unpopular choice any politician would make. And in fact, hardly any of them are suggesting we do that. So there's 3 trillion out of the 7 we're planning to spend this year. So we can't touch that. Defense is another thing. There's another trillion almost, and we're not going to change that. In fact, there's many who argue we should be spending more. And then there's interest on the debt. We have to make our interest payments. If we want to keep borrowing, we have to continue to pay interest. And then we have these 2 little slices, the non-defense discretionary. Well, that's highway, that's everything else that the government spends money on. And then the other category is, I have to refresh myself, but all this is to say that the government doesn't, that Congress really doesn't have a lot of discipline, and they don't have a lot of options. And so at some point, and if we look out 10 years, it's possible that the debt could certainly become a drag on the economy. If we look at the top right, we will see the deficits by year. We had a few years in the late 90s, early thousands where we actually ran a surplus and paid down on the debt, but then we quickly had the financial crisis of 08. That's that next big bump, and then we had the pandemic, the real big bump after that. And so we're borrowing at a better pace now, but we keep maxing out the credit cards, and at some point we will have to figure out how to manage that better. There are some who argue, oh, it doesn't matter, deficits don't matter. If there's anything we've learned over the last 30 years, deficits don't matter. I don't know that that's true. Nobody knows. There are other people that say this is going to kill us. I don't know that either, but it's something to pay attention to long term. And if we look at the bottom right, you can see that if we measure GDP, if we measure debt against the size of our economy, we're closely getting back to where we were in World War II, and so which was the worst period of debt that we've ever had to be in. So we just don't have a lot of experience here, and I think the real picture is nobody knows what this means for us. And there were people who argue that it doesn't matter, and there are other people that argue that it could have a really nasty impact on our economy. It's easy to point to other countries that have really run up big debt and say, well, look how it slowed them down and killed them. I don't disagree with that. I would also say that the US government has trillions of dollars of assets. If you think about all the land that the government owns, all the things that the government has. So we have a pretty strong balance sheet of property that doesn't really go into that, because nobody's suggesting we sell the Gettysburg National Military Park. But so it's kind of a weird thing. And and by the way, the world trades oil in dollars and probably will for the foreseeable future. And so being the world's reserve currency, and there's not really any good alternatives to the dollar, gives us a much longer runway. Does it matter or doesn't it? I don't know, but I think it could have an impact in the future. And so I think it's something worth paying attention to. We'll switch gears, and I want to talk about so we looked at the government's finances. Let's talk about our consumer finances. So the consumers are actually in pretty decent shape. If we look there, if we add up all the money that we all have and the value of our houses, there on the left, collectively, we're worth $181 trillion as a country, and we have about $20 trillion of debt. Not a bad place. Certainly much rather be a consumer on average than the federal government, right? And if we look at the upper right-hand corner, debt service as a percent of income, it is kind of getting back to its maybe longer term average, but people are borrowing and putting about 10% of their income towards debt retirement. And that's not a really bad place to be, although you can see it drop during the pandemic pretty dramatically, and now it's kind of come back. So something to keep an eye on. The other thing that's kind of a canary in the coal mine that people pay attention to is the early delinquencies, meaning like, hey, people borrowed money and now they can't pay for it. And we're starting to see an uptick in credit card and autos back to places we haven't seen probably in 10 or 15 years. So people are certainly borrowing again. We've seen and heard of lots of new cars, and people taking lots of trips and probably putting those on credit cards. And now starting to struggle to pay those. So it's just something to pay attention to. But again, the consumer continues to be strong. The consumer drives 70% of the US economy. And so we think that that's a good place to be long term. Savings is another thing we pay attention to. Are we saving or spending? Obviously, in the short term, if we don't save, that means we're spending, and that's good for the economy. Now, as a financial planner, I would also argue that saving is good for the long-term health of our country and its consumers if they have adequate reserves in the bank for emergencies and retirement and college and all the things we save for. And so what we're looking at there is the savings rate has dropped again. It had been very high during the pandemic, and now it's getting back to the mid 2000s where we were, where people are spending more. And there's a lot of reasons. People are borrowing more, they're spending more, and obviously inflation has gone up. And so the costs of everyday goods and services going to the grocery store has gotten more expensive for most Americans. And so it probably puts a lot of people in a difficult place to save. Upper right is kind of what we call excess savings that build up during the pandemic, and we still see a lot. So again, consumer balance sheets are still much stronger than they were pre-pandemic. They're not like they were 2 or 3 years ago, and probably inflation has eroded that. But we are starting to see us make progress on inflation, and so it's possible. But all this is to say, I think consumer is sitting pretty well on average right now. And then let's talk about unemployment. So you'll see here, obviously, I have the June unemployment number, which was at 4%. That's that blue line, and or excuse me, that gray line. And so we were, or excuse me, 4.1% in June, but our 90-day average was 4%, and so it jumped up here to 4.3% in here for the month of July. Which, by the way, they're going to go back and restate that 2 or 3 times, so it might be better or worse than we thought. And we typically get. Here's what I want to say about unemployment is I want to see several months of bad unemployment reports before I draw any conclusions. But the market didn't want to wait 3 months. It sold off on Monday. Gets a bad report Friday, it sells off. But one bad month doesn't mean, and if you look, and I don't have a slide for it, but if you look at unemployment reports for the last 10 years, we usually get 1 or 2 bad months a year. We just miss and we didn't have a good whatever. And so again, if it between now and the end of the year, if the unemployment rate keeps going up and we're not adding jobs or we're actually net losing jobs, then I would start to be concerned about our economy. But I don't think there's any reason to push the panic button, because you could have done that once or twice a year for the last 10 years. And so we're looking at wage growth is starting to slow. And that's, you know, that could be tough for the consumer, but that's also probably helping the inflation rate. Keeping prices more stabilized. And so there's just this kind of symbiotic relationship, as you can see, between wage growth and unemployment. And we're still in a reasonable place, certainly below our long-term averages on unemployment. And then inflation. So again, the inflation rate has finally, I think the Fed has made a lot of progress. I don't try to offer too many opinions, but there were a lot of people in the news this week saying, well, the Fed was too late to cut rates. They should have done it last. I would give the Fed credit. We are not in a recession, and they've lowered inflation, which is the idea of a soft landing. And so far, they've done it. Now, they could screw it all up, and we won't know till it's over, right? We don't know in the moment. But I have to laugh at people saying, oh, the Fed should or shouldn't do this. I think the Fed, first of all, doesn't care about politics. They try to keep politics out of their decision making. Their 2 mandates are inflation and unemployment. Those are the things they care about. And, you know, it's, oh, should they cut rates in a presidential election cycle? That could be good for one party. That doesn't matter. But what they're seeing is wage growth is slowing. The inflation rate, both the headline and the core inflation rate, are getting lower and getting close to their what they would like to see in the long term, which is 2%. And so the Fed has not created a recession yet, which is pretty unusual when they've raised rates historically this aggressively. It's caused a lot of economic pain, and they know that going into it and say, hey, we may cause a recession. I give them a lot of credit for getting inflation sort of under control without causing a recession yet. But there's still time. So I would not be critical of the Fed yet. I don't see any data to support, you know, go back one step. I don't see any data to support that the Fed has done anything wrong yet. Yes, if you're a stock market bull, you want to see the Fed cut rates because then people will put more money in stocks and it'll push the stock market. But at the same time, their broader mandate is keeping the economy healthy, and they have been able to do that. And we haven't seen inflation like this in 40 years. And so we'll continue to watch and see what happens. But I suspect a rate cut is coming, but we'll see here in a few months, or I guess next month. This is what makes up inflation. And just looking at the last 4 years, you can see all the different things that happened there. One of the interesting dynamics that I'll point out is the biggest contribution to inflation continues to be shelter. That's that dark blue line that seems to be driving most of the inflation. Housing costs are still very high, but they're starting to settle down. And again, when you raise rates, every time you raise the rates, you knock more and more borrowers, potential borrowers or home buyers out of the market. So that has slowed down the housing market and has probably helped get that under control. And that's the biggest thing driving. Dining, recreation, other are a big part of it. And the other thing that has emerged is auto insurance, go figure. And we know that, I know that now I had a child turn 16 in the last year too, but which really killed me. Jamie's got 3 young drivers on his policy. But the auto insurance has gone up, in part because cars have gotten more expensive and replacing and used cars have gone way up. So, that has finally trickled into auto insurance, which nobody was thinking about, but that's become a bigger part of the inflation is that if you get in a wreck today and the insurance company has to go buy you a new car, they have to spend more money to buy that car than they would have a year ago. And so we've really seen that push premiums higher. I was a little surprised when we got our bill. It did go up. When we added our daughter to the policy, it did go up 50%. But then, even beyond that, I was kind of scratching my head. So I'm probably not a good example. But she's been a good driver so far and not needed to use the insurance. Talking about the Fed and rates, what you see is where the Fed funds rate is, which trickles into a lot of other things and influences a lot of other things. We're really at a high that we haven't seen since probably 2001, 2002. But I would also add, and I think we have another slide on it, if we look at long-term history, and I see enough people around here probably can remember better than I do, interest rates are still historically low. When we bought our first house, our mortgage rate was 5.75%. And my parents and my in-laws said, "Oh, what a great deal. Lock that in." We've never seen an interest rate that low and that was 2001. We've never seen an interest rate that low in our lives. And of course, we all know that it went lower and lower and lower from there. But, they were borrowing at double digits when they bought their first homes, as I assume a lot of you may have as well. But what we see on the right is kind of where we think we're going. And the blue line or blue dotted line is what the Fed thinks it's going to do. And the green line is what the market thinks the Fed is going to do. And they're very closely aligned. Right now, if we looked at this over the last year or so, there was some divergence where the market bet that the Fed was going to raise or lower rates and the Fed didn't. But right now, they're very much in line. So I think there's a strong indication that rates will start to go down here in the next few years. But I don't expect them to go back to zero necessarily. And then thinking about interest rates and inflation. So I want to talk about the most common form of debt instrument that the U.S. government uses is the 10-year Treasury. So if you buy a 10-year bond, you give the government money for 10 years, and then they pay it back with interest over that time frame. And so what we see here is if we look at U.S. Treasuries are now at 4.2%, and then the gray is subtracts the inflation rate from that yield. What we see and continue to see is people are willing to lend us money and lose real dollars, meaning they're willing to take a 4% rate of return when inflation's 8%. And so, that's kind of silly to me, but, we're still, right now inflation's a little below 4% and we're lending the government money at 4%. And so the value in 10 years when I get my money back is unchanged. And that's unusual. And so again, this is why I think that the federal government has a pretty good checkbook. And I think they still have a lot of room to run. Although personally, as somebody who hopes to live a lot longer, that they figure it out sooner rather than later when it comes to Fed finances. And then just thinking about the global economy right now, you can see this is that just a lot of positive momentum. There's the top bars just show by quarter, kind of green is good, red is bad, economic growth. And we're seeing that across the board. Some places that I think the exception to that probably, Germany, France, Italy, Spain, Europe hasn't quite figured things out as well as the rest of the world, but both emerging markets and developed markets are doing very well right now. And then inflation, and this is where everybody's kind of gotten inflation under control. If we look down the right-hand side here, we're seeing a lot more blue, with one exception, that's Japan. So Japan finally said, you know what, we got inflation. We probably need to raise rates. They did, and that kind of created part of some of the panic that we've seen here over the last week. So Japan finally came around and said, we need to raise rates after kind of digging their heels in, unlike everybody else. European Central Bank, obviously Federal Reserve, have aggressively raised rates, and a lot of other places have as well. And so that has helped tamper inflation across the globe, except in Japan is still dealing with a lot of it. So this is an interesting chart, and I was going to share it with you, but I think it's still very relevant. And it's this idea of, and I'll use the example of my daughter. She just opened her first Roth IRA. She has her first job. She's got a Roth IRA. We're starting to save and invest with her and talk about this. And she's put money into a brokerage account at Fidelity, and it's sitting there earning interest. And I keep thinking, oh, she needs to buy a mutual fund or a stock or something with that money that she's building. Now it's getting better than 5% interest, so we're not too worried about it right now. But my point for her is, I kept thinking about, boy, she's going to get into stocks now, and we're at an all-time high. In fact, we've had a lot of days this year where the market's been at an all-time high. We've hit, the S&P 500 set over 45 or 50 new records this year so far, in terms of height. And what this tells us is, if I invested money on the highest, on a new record day, an all-time high, ATH, an all-time high, what would happen? And what was the interesting thing is, over a 5-year period, I actually did better than investing on any other day. And what this tells us is stocks have tremendous momentum for long-term investors. So there's some of us is like, let's wait for, we talked about bulls saying, let's wait till there's blood in the street and then we're going to buy. But even if we buy on the best days, like, hey, the stocks are an all-time high, I'm going to buy, I could lose because they're an all-time high, that still tends to be a good long-term play. So this is an interesting thing that I was not familiar with. And so my message to anybody is timing doesn't matter. If you're a long-term investor, get your money deployed in the market. And so when my daughter gets home on Saturday, we're going to have a little conversation about, hey, let's get this Roth IRA working for you. Although, stocks are a little bit on sale right now from the last week. But it was just an interesting juxtaposition of, we think, well, we don't want to buy high versus we want to buy low. And that's true. But the bigger picture is, if I'm a long-term investor, it doesn't matter. And this idea, when stocks are in motion and have momentum, as they have had most of this year, actually turns out to be a good time to invest for long-term investors. So I was actually surprised to learn this. And then finally, as we conclude today, just a reminder that diversification matters a great deal. And so again, this green chart on the left shows the broad range of stocks historically in a 1-year period. The blue shows the range of bonds, and the gray shows the range of a 60% stock, 40% bond portfolio of diversification. But as we go out to 5, 10, and 20 years, a diversified portfolio certainly is in a much tighter range, doesn't experience much in the way of loss, still has a good upside potential. And so the idea of staying invested and being diversified allows us to take advantage of all those inefficiencies as long-term investors in the market. Inefficiencies saying, hey, I've got my money spread over hundreds, if not thousands of stocks right now. And yeah, these magnificent 7 are doing awesome. And boy, I should have put it all in NVIDIA at the beginning of the year. I'd be a millionaire now. But the broader point is staying diversified for long periods of time has tremendous disciplined returns for our investors. So as we wrap up here, I do have some disclosures. You heard me say that this presentation is being recorded and posted online. I encourage you to go some night, and there's people that feel it's very important that you read and have access to all these disclosures. So go on our website, fast forward through this whole presentation, and then if you can't sleep, then you can read all of these disclosures. I will tell you that our compliance reviewers who will listen to this presentation, I'm very grateful for them, and they'll know that I've encouraged you all to read all these disclosures and definitions as we've gone along here. So you might have to pause it on each slide and really dig into it. And SEC says we have to use 8-point font at a minimum. So, it makes it real easy to read. Thank you so much for being here today. If anybody has any